What investors are actually doing after you leave the room. Nobody tells founders this. I want to show you exactly how I evaluate a company before I write a check, not the version that lives on every VC website. We look for great founders and large markets. The actual process, the specific conversation, the documents I request, the things that stop a process cold in this first week. And the Africa-specific factors that most due diligence checklists written in New York or London were never designed to catch. Because here is what most founders do not know. The pitch meeting is not where the investment decision happens. The pitch meeting is where the investors decide whether they're interested enough to start the process that leads to the investment decision. What happens after you leave that room, who I talk to, what I look for in the documents you send, how I think about the things you mentioned and the things you did not, that is the part that determines whether a check gets written. This episode is useful whether you are a founder preparing for a raise, an emerging fund manager building your own framework, or an investor who has been doing this informally and wants a more structured approach. I'm going to walk through 6 domains in the order they actually shape my assessment. Let me start with the one I always go to first. Due diligence is not primarily about finding reasons not to invest. That is a wrong mental model, and it leads to risk-adverse paralysis, especially in early-stage African markets, where some imperfections in the documentations, the team structure, or the traction curve is almost always present. Due diligence done correctly is about building enough understanding of a company to make a specific prediction. Will this team in this market with this business model be able to compound the capital we deploy into something that returns at least 10x? Everything in the diligence process is oriented towards that prediction. Understanding the investor's diligence framework is also tactically valuable for founders because it tells you where to invest your preparation energy. Founders who walk into a process with organized documentation, clear answers to the predictable questions, and a proactive acknowledgement of the risk, those founders move faster through diligence. Speed matters because investors' conviction fades when a process drags. So domain 1, the team. I start here because in an early stage company, the team is the product. The product would change. The market sizing would be revised. The business model would iterate. The team is the most durable asset in the company at the seed stage. Here's something I do that most investors do not talk about. If there are 2 co-founders, I ask them each the same question separately without the other one in the room. I ask, what does your co-founder do that you could not do? And I listen for 2 things: the specificity of the answer and the consistency between what each one says about the other. A co-founder pair that can describe each other's contribution precisely and consistently has done the work of understanding their own partnership. A co-founder pair where one person gives a vague answer and the other gives a very different vague answer has not. The gap will show up in the business. In the African context specifically, I also evaluate, does the team have a real operational presence in the market they are targeting? I visited Lagos. It's not the same as I have been doing sales calls in Lagos for 18 months. The founders who are in the markets, who have built relationships in the market, who understand the regulatory environment and the buyer behavior from direct experience, those are the teams that survive the execution challenges that are unique to building in Africa. Domain 2, the market. The market question I am answering is not, is this a big market? Because most of the time it is. Is there a clear path from where this company is today to capturing enough of a real market to produce a venture scale return? I want to give you the honest reaction to most common market sizing mistake I see. The first is typically like top-down total addressable market. The African tech market is X billion. We expect to capture 1%. I stop reading there. That number tells me nothing about whether this specific company can capture meaningful revenue in a specific segment at this stage. The market size I care about is built from the bottom up. How many customers exist who have this exact problem? What would they pay for this exact solution? And does that number at full penetration produce returns that justifies the check? Building a total addressable market from the bottom up every time. I also evaluate market concentration risk. If 80% of these company potential customers are in one city or in one country, what happens if a regulatory change, a currency crisis, or macro shocks hit that market? And I'm not asking them to avoid concentration. Sometimes concentration is often how you get to scale fastest. I'm asking whether the team has thought about it and has a plan. Domain 3, traction and unit economics. Traction means real customers paying real money and coming back. At pre-seed and seed, I expect to see some signal that the market wants what this company is building. That signal can be modest, but it needs to be real. In African markets, unit economics are particularly telling because the execution environment is harder. A company that has healthy unit economic, despite high infrastructure costs, payment friction, and the cost of offline distribution, that company is showing me something genuinely important. The business model is structurally sound, not just favorable under ideal conditions. A company that has attractive unit economics only because they have not yet had to deal with the full cost of operating at scale, that is a risk I need to price carefully. Domain 4, business model and revenue quality. Not all revenue is equal. I'm looking at how predictable is the revenue stream, how sticky is it, what is the ratio of recurring revenue to transactional revenue? Africa-specific consideration, payment allocation in many African markets is more complex than in more matured markets. A company with clean-looking revenue line that has significant account receivable aging, where a large portion of their billed revenue is more than 90 days uncollected, has a different financial health profile than the headline number suggests. Domain 5, governance and legal structure. This is a domain that most early-stage African founders are least prepared for, and it's also the one that most often causes investors reluctant to proceed, even when the business is good. This is the governance question I want to address directly, because it creates more deal friction than almost any other single issue. Cap table landmines. Every equity promise that was made informally, an early employee you told you would get some equity, an advisor you said we will work something out. That promise exists on a shadow cap table. When a sophisticated investor legal team runs the diligence, those promises surface and the close get delayed or repriced or even killed because the founder now has to resolve something they should have formalized a year ago. Clean the cap table now. Not before Series A, right now. I'm not looking for perfection. I'm looking for a founder who is honest about what is in order and what is not, and who has a plan to fix the things that need fixing before close. Domain 6, Africa-specific structural risk. This is the layer that most standard due diligence framework do not include. Currency risk. What is the company's revenue currency exposure? If the company earns in Naira, cedis, Kenyan shillings, and has dollar-dominant costs or investors who expect dollar returns, that gap needs to be understood and managed, not ignored. Second is regulatory risk. A business model that is fully legal in Kenya may require a different licensing structure in Nigeria. Founder needs to have done the regulatory homework in every market they need operating in. Cross-border expansion assumptions. Many pitches I see include a slide showing 10 African countries the company plans to be in by year 3. I probe that aggressively because cross-border expansion in Africa is genuinely difficult. Payment rails, regulatory requirements, language, consumer behavior, and the distribution infrastructure are all different across every border. The companies that expand well to do it sequentially and with real operational presence, not theoretically, there are things that disqualify companies in other markets that are explicitly looked past in early stage African investing because penalizing African founders for them reflects the assumption of a different ecosystem. I look past imperfect early financial records. As long as the founder is transparent and building towards proper accounting, I look past a founding team where one co-founder left the company. Founder departures are common in early stage companies everywhere. What I do not look past is dishonesty. A founder who misrepresents their team or their customer relationship even once is a founder I will not back. I'm evaluating honesty under pressure throughout the entire process, not just in the pitch meeting. Everything you say during diligence is data. The diligence process is not an adversarial audit. It is the beginning of a working relationship. The founder who treats it that way, who answers hard questions directly, who flags issues before I find them, who show me they can handle scrutiny. Those are the founders who move through diligence fastest and who build the kind of investor relationship that matters at the moment when things get hard. If you are a founder preparing for a raise, run this checklist on yourself before you go into any investor meeting. Team, market, traction, business model, governance, Africa-specific structural risk. If you cannot answer each domain with specifics, you are not ready to pitch yet. Spend that time closing the gaps instead. Drop in the comments which of the 6 domains is the one you are the least prepared for right now. I want to know where the gaps actually are, not the generic version, the specific ones. Okay. On the next episode, we're going to look at how to build a fundable startup when the infrastructure around you is genuinely broken. And until next time, have a good day.